Hello traders, Gary Wagner here, just after 11:30 in Honolulu, 4:30 in New York. It is Thursday, December 29th, 2016, and this is the Daily Report for Gold and Silver. We will combine today and tomorrow's show with trending markets to give it some unity, and also to look at the interrelationships in some of the markets as we go into the end of the year. Tremendous rally in gold today, with gold trading up about $18, actually over $18 today. Really propelling it off the recent lows that we saw as the market hit 1123, and that was 2 weeks ago. Whether or not this is technical confirmation that a bottom is at hand is exactly the topic that we'll cover today. But first, let's take a look at pricing. Gold closing up, as I said, $18, $1159.30. Now traded to a low of $1142.60 with a high of $1160.60. So as you can see, we're just a couple of ticks off the high. Net change putting it up over 1.5%. Silver also showing some strong gains, but traders, look at the fact that silver has not performed in terms of percentage gains to the level that we saw gold perform today. Very interesting change in the relationship between gold and silver, but silver still showing a solid performance, up over a full percent at 1621. The low today, 1604, and the high, 1631. Now that all in light with the equities markets, which traded under very minor pressure today. I would call the Dow Jones Industrial Average fractionally unchanged, 19,819, down about 14 points, not even a full 0.1% in terms of the net change. Whether or not we will see 20,000 in 2016 becomes more and more remote, and with only 1 day left in trading, at this point, I believe it is highly unlikely. However, given what we have seen over the last couple of years, nothing would surprise me. So we could see it, but it's not something that I am looking for. But the big thing that we do want to talk about today in terms of outside influences in the precious metals is the US dollar, because the dollar came down substantially, trading down by 0.6% at 102.66. And whether or not that is a signal of things to come, or just a short rest area before returning to its bullish demeanor, is something we absolutely need to focus upon. So traders, it is hard to believe that this year is quickly coming to a conclusion, with only 2 more trading days for the year, 2 more shows today and tomorrow. And the focus of these next 2 shows will be, of course, our Gold Forecast 2017. This will be a precursor to tomorrow's weekend review, in which we will really lay out in detail our model for next year's trading activity and the ranges that we believe gold prices could actually go to. First of all, we are definitely ending the year on an interesting note. We're looking at a standard bar chart, daily chart, and the reason that I want to use bars rather than candles is I really want to focus on the lows and the highs of the market. We can really see the kind of activity we got. This, of course, is November the 8th. This would be election day, and the reason I can pick that out so easily, it is that key distinction of this extreme high that was achieved immediately following the election voting part of it, as they were tallying the votes, and when it was first believed that Hillary Clinton didn't have the presidential election locked up, and there was some possibility that Donald Trump, in fact, would become the 45th president of the United States. We saw this market trade dramatically higher, trading up to about $13.40, just $40 shy of the yearly high that we achieved. It was a double top, the first occurrence, of course, in July. It then began to trade dramatically lower, closing under pressure, therefore being a red bar. I'm still coding this like I would a candle. And from November the 8th up until really December the 15th, we really saw, at least on a weekly basis, consistent lower lows and lower highs, but we hit this low on December 15th, which came in right at 1123, and it is this candle here. Now, the reason that that particular price point has drawn so much attention to myself and other technical traders is the fact that that was exactly a 75% retracement of the yearly move that we saw within gold as gold traded from a low at the beginning of the year at $10.50 all the way up to the highs at $13.80, and this is that double top I just spoke about. And then when we run our retracement from that, 75% takes us to 1123, 78% takes us to 1113. Now, a 78% retracement is a critical number that we would use in terms of Fibonacci retracements, but 75% is a number we use in Elliott wave modeling, because typically on what is called a corrective B wave, which is what I believe we are currently in, the market will correct from the initial rally, which is this move here, anywhere between 50%, which comes out to 1209, and 75%, which comes out at 1123 right up here. So the fact that the market stalled at this point was our first indication that we really wanted to look for a bottom. But if you recall from the last couple of weeks, my question was whether it would find support in this area here, or in fact whether or not we would see it drift to the 78% retracement level. Well, over the last couple of weeks, and especially today, we've gotten the answer to that question. And the answer is categorically yes. That turned out to be, at least on a short-term basis, real support in the market, as we've now seen this market rally $40 off of those recent lows, which tells me that we have a real possibility that what we are looking at is our A wave here, and the fact is our B wave might have concluded December 15th. If that's the case, on tomorrow's show, we'll plot where we think it could go, but that would mean we are in a C wave. A C wave would, of course, move in the same direction as the A wave, which means that we are in store for gold to move to higher pricing. And that, traders, is extremely exciting. And it doesn't just signal the potential conclusion of this correction, meaning the correction that began in August and ran up till current pricing, but rather the multi-year correction which began at the end of 2011, beginning of 2012, and it was prevalent in the market over the last 4 to 5 years. In other words, through 2013, 14, and 15. And it wasn't till the end of 2015 where we reached these lows at 1050. So if we can say with any kind of certainty that this long correction has concluded, that is a tremendous change in market sentiment, in market demeanor, and where we can expect prices to go next year. Now, the technical evidence that I'm citing to back up this assumption, or hypothesis, I should say, is the fact that the yearly high reached this year, as well as the yearly low, because we are now within a day away from the conclusion of this year, we had a higher high and a higher low than we saw in 2015. That is the first time we can say that that occurrence has taken place since 2011, 2012. So with that in mind, my sense is that we might be looking at, one, the conclusion of a multi-year rally, or a multi-year correction, and we might be moving into a sustained upside rally in which we had a long major A, which began here and concluded here. We are in a major B, which will be composed of a B wave. That B wave would be an ABC if we broke it down. We've completed our A, and we might in fact have now completed our B, which means that we are now entering our C wave, which is a rally wave. We'll talk about where we think that that could take us to and what we're looking for in terms of our forecast for 2017 tomorrow. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you for the weekly wrap-up and yearly wrap-up tomorrow on the Weekend Review. Till then, Bye-bye.